This morning, we are absolutely delighted to have James Rickards with us. James is an American lawyer, economist, and investment banker with 40 years of experience working in capital markets on Wall Street. He was the principal negotiator on the rescue of long-term capital management by the U.S. Federal Reserve in 1998. He has been an advisor to on capital markets to the U.S. intelligence community, the Office of the Secretary of Defense at the Pentagon, and several U.S. presidents. He has also testified in front of the U.S. House of Representatives on the 2008 financial crisis. He is a prolific author with best-selling books on currency wars, gold, and the Great Depression. His most recent work is Money GPT, AI and the Threat to the Global Economy. His most recent essays can be found on dailyreckoning.com. Thank you so much for coming on the show, James.
Thank you, Todd. It's great to be with you.
In your latest book, Money GPT, which is really outstanding, your first essay on how AI and our geopolitical enemies could manufacture a financial crisis was, well, funny and incredibly eerie for someone who's been in the markets for a long time. How do we guard against something like that? Because, the machines essentially run trading.
That's right. So I cover a number of different topics in my book, Money GPT, but chapter one is a description of how a financial meltdown could occur because of the introduction of AI into markets and trading. So there's nothing, it's funny, it's a nonfiction book, but when you do futuristic scenarios or forecasts, you're kind of writing fiction because it hasn't happened yet. But my point to the reader is that it could happen. It almost certainly will happen, and you ought to be ready for it. So it was take it as a warning. But yes, I tried to make it as realistic as possible. And the idea is there's nothing new about financial panics. We've had financial panics since the 14th century, probably older than that, but you can go back to the Black Death in the Middle Ages and find banks where there was a run on the bank and so forth. So that's not new. What is new is the degree of automation and the introduction of AI into the chain of execution, settlement, and clearance, and how that can actually make the markets more vulnerable. People say, well, you can't see a market bubble. When they happen and they break, and after the fact, you can say, oh, gee, that was a bubble, but you can't see that at the time. That's nonsense. There's nothing easier to see than a bubble. The hard part is knowing when it's going to break. And bubbles can go on a lot longer than people expect. I always say you can lose a lot of money being right. You can be right about the bubble, but you don't want to short the market because it could keep going up. So then the hard question is what's going to pop it, what's going to break it? And the answer is a lot of things. Could be geopolitical, could be a natural disaster, could be just kind of something unexpected that hits the headlines. But the point about the difference with AI in the chain of execution, the order entry and the settlement and all that, everything I just described, and also the news cycle, very importantly, is that it acts as an accelerator. It makes everything faster, more dramatic, more unexpected, and therefore more likely. So in this scenario, and chapter one is all about capital markets, the stock market, basically. In chapter one, AI performs several roles. Number one, a lot of order execution. Today, 95% of all the trading on the New York Stock Exchange is completely automated. The days of the specialists around a post making a two-way market in stocks and people running up to them and crowds, that's all gone. I have good friends on the floor of the New York Stock Exchange. I know the director of floor operations. He said to me not that long ago, and I was down on the floor of the exchange with him. The floor of the exchange is it's like half museum, half TV set. It looks good on TV, but all the trading is automated. And he said, Jim, there is no liquidity on this floor. Don't let anyone ever tell you that in a panic, the floor brokers are going to save the day. We make a living, we run a business, but there's no liquidity here. And I think that's exactly right. Now it's to the point where like I could put in a stop order or limit my losses, et cetera. But now the trading is actually being handed over to AI. AI is making the decisions. So it's no longer a human trader with an automatic trade entry system, putting in a few orders, and then the system carries it out. This is completely handed off to AI. AI looks at the markets. AI looks at individual stocks, whether going up or down or volume, the acceleration in a fall, and makes its own decisions. There's no human intervention at all. So that's your first problem, which is that there's no ability for a human to say, huh, maybe this is a panic, maybe it isn't, maybe I should buy the dips, maybe this is a good opportunity to step in, maybe I ought to sell more, go to the sidelines, etc. Those decisions are being made by AI on an automated basis. So there's no kind of human judgment or intuition involved. So that's the first point. The second point is, okay, I say we've handed off trading to AI, which we have. What's the program behind it? How is that AI programmed? How does it decide? I'll put that in quotation marks. How does the AI decide what to do? Well, AI has what's called a training set. And a training set is a large body of data. It can be the entire internet. I mean, you can buy the internet. I don't know exactly how much it costs, but you can buy however many billion pages of information on the internet. You can buy that and use it. Most developers training AI programs use a subset of that, a little bit curated, but it's still a massive amount of data. So the AI goes through the data, and what does it see? What's the best strategy for you as an individual trader in a panic? Well, basically, sell everything, go to cash, move to the sidelines, wait it out, and then step back in. Once all the damage is done, come in and buy things on a bargain basis. Warren Buffett is very good at that. So, okay. But that makes sense for an individual. But what happens if everybody does it? And this is something called in economics is called the fallacy of composition. So let me give you, which means that something that works for the individual fails massively when done at a large scale. So let me give a very simple example of that. You're at a baseball game, and the person in front of you is kind of tall. They're wearing a big hat or whatever. You can't see the game very well. You're not happy about that. So what do you do? Well, you stand up. You stand up and you go, hey, I got a great view. This works for me. But what happens next? Well, the person behind you stands up and the person behind her stands up. And pretty soon, everybody in the stadium is on their feet to see the game. They all have exactly the same view because relatively nothing has changed, but everybody's worse off because you're all standing up. So there's an example of something for the individual. Yeah, it works, but on a mass scale, it produces, it's costly and gets you no further ahead. Now, as applied to capital markets, same thing. The strategy of selling everything, going to cash, moving to silence, waiting out is actually a good strategy. If you do that early in a panic, you'll come through, you'll cut your losses, and you'll be able to buy on a bargain basis. But what happens when everybody does it? When everybody in the stadium is standing up, they're all sellers, no buyers. The market goes straight down, blows through the circuit breakers, goes through the floor, and gets so bad that the exchange governors, the regulators, close the markets. You can get through these circuit breakers in 10 or 15 minutes and go through all three of them in over the course of an hour or so and shut the market. And then they can, even when the market is shut, they can still see what's called the back of the book. Like what are all the bids and offers that are kind of piled up, waiting in the queue to be executed, and they might keep the market closed, tomorrow and the day after, and really not find any very easy way out of it. So that's one impact of AI, which is it's programmed to do something that makes sense for an individual, but is catastrophic on a mass scale. So that's one aspect that I explore. Two other aspects. One is, and this is part of AI, is basically, image generation. So, this I'm real, you're real. We're doing a real interview right now, but it doesn't take much to create a digital clones. And you can, if you have a good enough sample, and I talk about this in my book, in my example. Let's just take any public figure, and Jay Powell's a good example, chairman of the Fed, but it could be a head of state, a CEO, it could be anybody. If you have enough footage, enough video footage, digital footage of that person giving speeches, giving interviews, etc., and you have enough recordings of their voice, same thing, digital tracks of their voice, you can take that and put it into a computer and generate a digital image that is very convincing. This could happen tomorrow. That's the point. All of the technology that I discussed, it gets bigger and faster, but it's there today. So I have basically rogue actors who rogue criminal hedge fund traders basically. Then they do fake press releases and saying that the chairman just gave a speech that indicated he was going to raise interest rates, because this is a world where everyone expects the Fed to cut interest rates. But he says, well, not so fast. We may have to raise them. That triggers the market panic. Then it gets into the CNBC reporters, the TV reporters are calling the Fed, hey, what's up with this? We heard the chairman said this. Oh, he's on a plane. We can't get him right now. And then they finally track him down. And meanwhile, the market's crashing and the Fed chair is tied up on a plane. This is all sort of, orchestrated in that sense. So that's the second aspect of it, which are, basically digital fakes of prominent people saying things that they didn't actually say. Um, and there's a third aspect to it, which is, and this is very important. In my scenario, I mentioned, these rogue criminal trader, hedge fund traders in Mallorca and what they're doing. But I also have a Chinese intelligence operation that wants to launch a financial attack on the United States. And when you do that, this is a military term, it's called force multiplier. You have a certain number of resources, call them weapons or financial weapons at your disposal, and you launch them. But is there something else you can bring in that will make them even more powerful? And if you're trying to crash a market digitally, you would do it on a day when the market's already down. So if the market's rallying and you're trying to crash the market, you're pushing against a headwind or a tide. But if you take a day when the market's already going down and then you jump in, the market will go down faster. The fourth element is a hack of the order entry system. I picked Morgan Stanley. Morgan Stanley is a great firm, by the way. I knew James Gorman, the former CEO. They're good people, but you got to pick somebody. So I picked on them. Their order entry system gets hacked, and they're just sending in orders to the New York Stock Exchange. Sell Apple, sell Google, sell Meta, whatever. But they're being generated by this Chinese team. They're not actual orders, but you don't know it if somebody's hacked your order entry system. So finally, the New York Stock Exchange calls up and says, "Hey, you have to stand up to all these orders." And they say, "No, because they're fake, they're not ours, etc." And then the New York Stock Exchange says, "Well, sorry, we're kicking you off the exchange. We're not clearing your trades because you won't stand up to them." And then the word gets out, and then by the late in the day, Morgan Stanley's in collapse. So my
Leaving
my
all
point.
over again, basically.
Correct. Right. So my point is that there was no one mastermind. It wasn't just one actor or one top-down plot. It was all these things coming together in under complexity theory. There's a name for that. It's called an emergent property. Something that comes out of a lot of different actions, but you couldn't infer it if you had all the data, you wouldn't know what's going to happen next, in other words. So putting all these things together, the fallacy of composition, the speed, the amplification, the acceleration, and the fact that there's no mastermind, but all these things come together, it's the perfect recipe for a total market meltdown.
How do we guard against something like that? Because the story felt so real to me, having gone through the great financial crisis and being a market maker and seeing actually today how easily you can do a deep fake. How do we guard against something like that?
For an investor, an individual investor, an institutional investor, or any of the folks watching this program, you would say to yourself, well, maybe I can't stop that, but I can prepare for it. I can structure my portfolio in such a way that if that happens, I won't be wiped out. And the best way to do that, of course, is diversification. And I say diversification, people roll their eyes and go, "Oh, Jim, everybody knows that. Diversify. That's old hat." But they actually don't. They say they do, but they don't. Because I run into people all the time. They go, "Hey, Jim, I'm fully diversified. I've got 50 stocks in 10 sectors. I've got semiconductors, consumer non-durables, defense, minerals and mining, etc." And I say, you're not diversified. You may have 50 stocks in 10 sectors, but you have one asset class, stocks.
The
They go
correlation
down.
goes to one in a disaster.
They're all going to go down together pretty much in the scenario I described. Real diversification looks like this. Yeah, have a slice of stocks. I'm not saying get out of the stock market, but make it, 20%, not 70%. Then have a slice of U.S. Treasury notes, which I expect will perform very well. 10-year Treasury note, the yield to maturity right now is about 4.25, but it's been in a very narrow range. Which, if you're a technician, when something trades in a narrow range for a long period of time, that's a signal that it's going to break out, and it could break out up or down. My expectation is there's good reason for this, that the interest rates will break down, which means the value of the notes goes up. It's bond math 101. When rates go down, the value of the note goes up. So I could see U.S. interest rates going to, in that 10-year maturity going to like 2.5. So if you go from 4.25 to 2.5, you're going to have, first of all, you'll be very happy with your 4.25 coupon. You're going to like that, but the value of the note is going to go up a lot. So you could have huge capital gains based on that alone. And then has some cash, and I recommend a pretty big slug of cash, maybe 30%. And people, I mean, if I said that 3 years ago, people go, Jim, there's no yield on cash. Um, but that's not true today. You can actually get 4% on your cash. I know that's not, 20% or something that people look for, but you can get 4% on your cash. But here's the value of cash, and this is not well understood. First of all, you won't lose anything. You won't make a fortune on your cash, at least not right away, but you won't lose anything. So that reduces the volatility of the rest of the portfolio. If you have volatile assets, and that could be gold or stocks, and you have a slug of cash, the overall portfolio volatility is going to go down so that it can help you sleep at night. You will get some yield, but here's the real value of cash. It has huge embedded optionality. If I said, hey, Ty, I'm going to sell you an at-the-money call on every asset class in the world, what's that worth? You say, well, it sounds pretty valuable to me, but well, that's what cash is. When the crash comes, you're the one who can go shopping, go out there and buy all these stocks, down half or down 60% or whatever it may be, and get some very good bargains. And by the way, among institutional investors, who has the most cash right now? It's
Berkshire
Warren Buffett.
Hathaway.
Well, Berkshire Hathaway. They have over a third of $1 trillion in cash, cash equivalents, treasury bills or whatever, a third of $1 trillion in cash. Why do they have that? Because they see what I see. They see what we're talking about, which is this meltdown's coming, and they want to be ready for it. And again, they'll go shopping when the time comes, but you have to be patient. Then, absolutely have some gold or silver, but I recommend gold for 10% of your portfolio. I think it's going to do extremely well. I wouldn't recommend it otherwise. But I always look at the downside. Maybe after having been through long-term capital management, that's a little bit ingrained in me. But if you have 10% of your portfolio in gold, now I expect gold to go up. I just want to be clear about that, like a lot. But if it went down 20%, so if you have 10% down 20%, that's only a 2% loss on your portfolio, which is not that bad. So it's going to limit your downside, but the upside is huge. And by the way, one of the reasons I don't expect it to go down a lot is because the central banks are net buyers. From 1970 to 2010, 40 years, central banks were net sellers. 2010 was the inflection point. They became net buyers. Not the same central banks. The buyers are Russia, China, Kazakhstan, Vietnam, believe it or not, Turkey, Iran. Iran's non-transparent, but they're a big buyer of gold for a lot of reasons. But central banks are smart. Central banks are sovereign wealth funds, finance ministries, basically government buyers. They don't want to pay too much, and they're long-term buyers, so they don't mind if the price goes down a little bit, but they're putting a floor under the market. If the price dips, they're the buy the dip people. They'll buy it, shoot it in. So this is what I call an asymmetric trade. You have limited downside because the central banks are there ready to buy, but you have unlimited upside as some of these panics play out. So I like gold. So that's what a diversified portfolio looks like. In round numbers, maybe 20% stocks, uh, 10 or 20% treasury notes. You can do shorter maturities if you like, they're less volatile. 30% cash, 10% gold, and there's room for alternative assets and residential real estate. That's a diversified portfolio.
Another topic that I want to get to is, as you mentioned, the central banks started buying gold in earnest. I think you can almost mark it to the to the period right after Russia invades Ukraine, and we freeze SWIFT. We freeze Russian assets. We freeze them out of SWIFT, and I think China and a lot of third world countries said, oh my word, they could do that to us. And then they start accumulating gold and sort of de-dollarizing to the extent that they can. One of the, I guess, luxuries that we have had as the reserve currency is we've been able to borrow tremendous amounts of money that certainly the UK can no longer do, as we've seen recently. Um, and we've had a generation of that where the bond yields always just keep creeping lower, and there's always buyers of bonds. Have we boxed ourselves into a situation where the rest of the world, and you could say our enemies hate us and our friends kind of resent us, and it's always been that way, that it's going to be harder to fund ourselves in the way that we've been used to? Does that become sort of, maybe not an existential, but at least a very serious problem for being able to fund this growing pile of debt?
Well, that's a great four-part compound question. So I like this. Let me disaggregate that a little bit, but I'll take them one at a time. So the first thing, you're right that since the war in Ukraine began in 2022, and the U.S. put very harsh sanctions on Russia, which haven't worked, by the way. All the sanctions have failed. They were imposed, but they ended up imposing costs on the United States. They haven't hurt the Russian economy. Russian economy is outperforming the U.S. economy. They're the only economic problem in Russia is there's a labor shortage because the economy is on a war footing and it's doing so well that you got to, and you have to keep finding more workers. So the ruble is stable. Remember, 2022, Joe Biden, to the extent he could put a sentence together, said the ruble is rubble. We're going to make the ruble rubble. No, the ruble's been very steady against the U.S. dollar. It's even a little bit stronger than it was at the beginning of the war. But to your point, Ty, Russia started buying gold, a lot of gold in 2009. They did this, 13 years before the invasion before the special military operation in Ukraine. They saw it coming, not, to the day or exactly what happened, but they could see the situation getting worse and worse. I mean, it was in 2008 that George W. Bush said at the Bucharest Declaration, he said that Ukraine should become part of NATO. So that was the starting gun. That's what started the war in 2008 when George Bush said Ukraine should be part of NATO. That's when Russia started buying gold. It was really 2009. They had 600 tons. Okay, so the head of the central bank of Russia is Vera Nabulina. I like to say she's the only central bank in the world who actually understands her job. She got over the next 14, 13 years to the day of the invasion. She got gold, physical gold, stored in Russia up to 25% of their reserve position. So the reserve position was about $600 billion, and 25% of that, or about $150 billion, was in physical gold. Now, it's true that a lot of the rest, over 300 billion, was in U.S. Treasury securities. Those were frozen by the United States. Now the US and Europe are in the process of stealing them. And that does have the kind of implication you described, which is if you're Saudi Arabia or China or Taiwan or Japan or anybody else, and you have large holdings of US Treasury securities, and you watch the United States steal them from Russia, because after all, Russia made the dollars by exporting oil legitimately, invested in the Treasury securities with their dollars legitimately in good faith and reliance on the U.S. rule of law, and now we're stealing them. You can argue the politics all day long, but those are the simple facts. So if you're any one of those countries, it makes you really, really wary of holding U.S. Treasury securities because the United States and Europe have kind of abandoned the rule of law. But uh, but 150 billion was in gold. You can't freeze it, you can't seize it, you can't trace it. Physical gold can be melted down, recast. It's not even a molecule, it's an atom, atomic number 79. I mean, you cannot trace it. So that gold is safe and sound. Not only that, but by driving up the price of gold, Russia made $50 billion in mark-to-market profits on their gold because the gold went from about 1,800. Now actually as close as we're doing this is close to an all-time high, over $3,400 an ounce. So Russia made $50 billion. Actually, the number is bigger today of mark-to-market profits on the gold. So tell me exactly how you're hurting Russia by kicking them out of SWIFT and doing all those things. You're not. They were all failures. It does create an incentive to buy gold, but Russia was 10 years or 13 years ahead of the curve. They could see this coming, and Russia's gone from 600 tons in 2009 to almost 3,000 tons today.
You mentioned how it's hurt us. has people trying, looks like there's a concerted effort, or feels like anyway, to try to avoid US Treasury bonds, which makes potentially our funding costs more expensive. Has that hurt us, and will that continue to hurt us?
No, it is a fact that basically foreign central banks and finance ministries have been selling U.S. Treasury notes and bonds. That's a fact. The Treasury has a monthly report. It's called the Treasury International report, and it shows, by country how many U.S. government securities you want. China in recent months has been kind of flat. They haven't sold a lot, but they haven't bought a lot. But prior to that, they were sellers, and other countries are sellers. So the phenomena of countries selling U.S. Treasury securities on net is true. But it doesn't mean what people think. There's this narrative. See, Wall Street loves narratives. They love a story. I'll tell you a story, try to sell you stuff or whatever. The narrative is, oh, it's the end of the dollar is crashing, the end of the dollar's reserve currency, and all these foreign central banks are selling Treasury securities. They're dumping the Treasury. Not true. They are selling them, but they're selling them for different reasons. They are desperate for dollars. There's a global dollar shortage. They wish they had more. And people think they talk about reserve currencies as if your reserves are your savings account. If you export more than you import, you pile up surpluses, and they're your reserves. And the question is, what do you do with them? Well, you don't hold them in currency. You don't hold them in, it's not like they're pallets of $100 bills in the basement of the People's Bank of China, or Korea or Japan or anywhere else. You have to invest them in something. And they invest in U.S. Treasury securities to a great extent. Now, they're denominated in dollars. That's true. But they're not actually dollars. They're Treasury securities, Treasury notes. So why is China selling Treasury securities today? They're doing it because they need the cash. They need the dollars to prop up their banks, to prop up their currency. They're desperate for dollars, and they wish they had more. So this phenomena of countries selling Treasury securities on net, it is true, but it's not a sign of getting out of U.S. Treasury securities. It's a sign of desperation because they need the cash. So that actually is very bullish for the dollar, just as it is. Now, as far as the so-called bond vigilantes, I was around in the 1980s when the bond vigilantes were writing. The bond vigilantes are gone. They have not saddled up. There's no widespread, flight from the dollar. The yield to maturity on the 10-year Treasury note has been in a range between 4.25 and 4.5. All right, it goes up one day, it goes down the next. My expectation is it's going to go down a lot starting now. I mean, I think the trend has already started, but not for good reasons. Trump's banging the table to the Fed, lower rates, lower rates. The Fed's kind of irrelevant, by the way, because actual short-term rates today are below the Fed funds target rate. If you look at 4-week Treasury bills, which are, ultra safe, ultra liquid, one of the shortest maturity Treasury bills, or something called the secured overnight financing rate, or SOFR, which is basically the repo rate. Those are like ultra safe short-term interest rates in dollars. They're both lower than the Fed funds target rate. So who cares about the Fed? The actual market, the Fed's not leading the market. The Fed is following the market. Those interest rates are already down, and they'll go lower, but they're not down for good reasons. They're down because the economy is going into a recession. So just to kind of summarize it, the dollar's fine. The Treasury securities market is fine. If they're net sellers abroad, it's because they're desperate for dollars. There's a dollar shortage. The Fed's irrelevant. Actual short-term rates are coming down, but that's not a good thing because it's a sign of a weak economy, not a strong economy.
I want to. The two things I want to get to. So just very, very quickly on the first one is the administration's tariffs. Are they, are we really raising money for, are we really targeting our trade partners, or is it really kind of a little bit of a stealth corporate as well as a consumption tax on citizens? And is it going to have the effect? Oh,
Excuse me.
bless you. Is it going to have the desired effect of, bringing industry back to the U.S.? Sometimes you find that a little hard to believe.
Well, it's a mixture of, first of all, it's a big revenue raiser. It's raising hundreds of billions of dollars. Last month, the U.S. had his first budget surplus in I don't know how many years, but it's been a long time. So the revenue raising potential is real. The Congressional Budget Office in the United States, when Trump passed the one big beautiful bill, Congress passed it and Trump signed it. The Congressional Budget Office said it was going to raise U.S. deficits by several trillion dollars over the next 5 years. The Congressional Budget Office has never been right about anything. I mean, they have forecasts every year. Go back and look at the last 10 years of CBO forecasts. They were wrong every single time. So I don't give them any credence at all. And the data, like hard data, as opposed to some nonsense estimates, is that we're running surpluses, at least in the short run, and hundreds of billions of dollars of revenue are coming in. So tariffs are a major revenue raiser. Now, second part of your question, Ty, is this a tax on consumers? Absolutely not. This notion that, oh, tariffs are horrible, they're going to cause inflation, prices are going to go up. That is not true. Here's how it works. There are at least three, I'll call it major parties to an import-export transaction. It could be 20 in the supply chain, but let's just take three notionally. There's the manufacturer, the exporter in China. There's the importer in the United States who actually receives the goods at the Port of Los Angeles or Houston or Savannah or any other port. And then there's the consumer who buys the goods. So you have the exporter, the importer, and the consumer. I'll tell you who does not pay the tariff: the consumer. The consumer's tapped out. I mean, auto loan delinquencies are going up, home equity is evaporating, credit cards are tapped out, et cetera. The consumer, they'll only bear with a price increase where there's inelastic demand, like gas at the pump. Like, yeah, you got to buy gasoline and to take the kids to school or go to work or shop or whatever. But other than that, there's enormous consumer discretion. They'll substitute one good for another. They'll just do without. They won't buy luxury goods, et cetera. But they're not going to pay that tariff. So who actually writes the check to the Treasury? It's the importer, the individual or company at, in my example, the Port of Los Angeles, who receives the goods. You have to write a check to the Treasury before you can distribute those goods in the United States. Okay, so that's the person who writes the check. But who bears the economic cost? Because you can push it up or down the supply chain. Well, I just described how it's not getting pushed to the consumer. It's getting pushed back up the supply chain to the producer. The importer, in my example, it takes the goods in Los Angeles, turns to the Chinese exporter and says, hey, you got to lower your costs. You figure it out. That's your problem. You're paying your workers in yuan. Well, devalue your currency or pay them less or tell your suppliers to lower their costs, do whatever it takes. But if I have to pay a 20% markup because of the tariff, you need to lower your cost 20% so that it's all the same to me. Now, that cost could be split between the exporter and the importer. Maybe the importer has got to have lower margins or lower profits. Could mean lower stock prices, by the way. But the importer and the exporter are going to bear the cost. They're going to share it between them on some basis. That's negotiable. But the consumer is not going to pay it. So there is a cost. I'm not saying it's a free ride, but it's borne by the exporter and the importer, not by the consumer, number one. Number two, Trump said, you foreign producers, you can sell anything you want to Americans at any time, whatever you want, with no tariffs. But you have to build it, put your factory in the United States, put your distribution centers, your assembly or whatever in the United States, and there's no tariffs. So the tariff wall is there. If you want to go through the tariff wall, you got to pay the tariff. We just talked about that. But you can jump the tariff wall by putting your car factory, your assembly plant, or your semiconductor fab, or whatever it is, in the United States. And that's happening too. And what do you get out of that? You get high-paying jobs. There's a famous story of the early 20th century, around, I think, 1912 or 13, somewhere in there, when Henry Ford gave his workers a $5 raise. And the other oligarchs of the time said, Ford, are you crazy giving your workers a raise? He said, I'm doing it because I want them to be able to afford to buy my cars. In other words, when the consumer has more money, guess what they do? They go shopping, they buy stuff. This is how you stimulate the U.S. economy. These are high-paying jobs, by the way. I mean, there's dignity in all work, but when you're working in a semiconductor fab or an auto assembly line or whatever, those are high-paying jobs. So tariffs are not inflationary. They create high-paying jobs. They're very good for the U.S. economy. And Ty, just to wrap up, I have this discussion with correspondents and interviewers and others all over the world. And they say, hey, yeah, Jim, okay, I hear you. It makes sense. Sounds like you're right. But isn't this going to hurt China or Brazil or Thailand or Malaysia, aren't those countries possibly hurt by this? And my answer is too bad. I mean, maybe yes, but that's their problem. It's up to Xi Jinping to make China great again. It's up to the prime ministers in these other countries to make their countries great again. Trump's job is to make America great again. So this is good for America for all the reasons I described. If Brazil has a problem with it, then hey, Lula, go make Brazil great again. That's not our problem.
The last thing I want to do in the little bit of time that we have left is you wrote about recently in one of your essays, I think in the Daily Reckoning, that China, is losing the mandate of heaven, and briefly, and I'm sure there's a lot to talk about in China. Uh, you talk about how there are a lot of ghost cities and issues, but are they really in so much danger because they have a surveillance state that would make the Stasi absolutely green with jealousy? They see everything, they can cover everything, they watch everything. Are they truly in significant, danger?
Well, the answer is yes. You're right about the surveillance state. That's absolutely the case. But what good does your surveillance state do you if 100,000 people are rioting in the streets and smashing store windows? And I mean, it's a lot of people to round up. But more to the point, the Chinese Communist Party sees the problem. They understand they're grossly over indebted. They've wasted trillions upon trillions of dollars of investment. And I've been to the ghost cities, the construction sites. And you go out there and they're real buildings. I mean, there's like steel and concrete and aluminum and glass and cement, and they're skyscrapers and apartment buildings, mixed use centers, shopping centers, golf courses, country clubs, lakes, parks, highway access, all of the above. And it's all empty. I mean, so they're there, but they're empty, and they may fill up slowly, but even then, people underestimate the cost of maintenance. Things like that fall apart pretty quickly. So uh, so the point is, when you're doing it, that counts as GDP. Some workers are getting paid, steel is being delivered, glass is being delivered. That counts as GDP. But if you apply generally accepted accounting principles, which they don't, of course, but if you did, you'd write it off. You say, yeah, we build it for, however many billion dollars, but we got to write it off to zero because it has no income, it has no productive capability. But they don't do that in their GDP numbers. So the GDP numbers are grossly inflated by the amount of wasted investment, which should be written off. So that by itself would, I mean, their GDP growth has dropped from 10% to about 5% today, five and a quarter maybe. It's actually closer to two and a half, maybe zero, maybe negative. So they have massive indebtedness, which slows down growth anyway. Wasted investment, which just write it off, so that doesn't count as growth, et cetera. Youth unemployment was 27%. Bearing in mind, youth are the one, 16 to 29. They're the ones, trying to form families, trying to buy houses. They're the most volatile, the ones most likely to go out in the street and protest. That unemployment number was 27%. About 3 months ago, China stopped reporting it. So I don't know what the number is today, but I do know when you stop reporting data, it's probably bad. You'd be happy to report good data. So let's say youth unemployment is over 30%. That's a powder keg waiting for a detonator, waiting for a match. So now I just described a whole long list of problems, and there are others. I mean, you're looking at the greatest demographic collapse in history. Uh, China, they say they have 1.4 billion people. Maybe, I don't think anyone knows the real number, but demographically, that number is going to decline by over a third in the next 50 years. So if you think of a simplified version of GDP, they're complicated formulas for GDP, but the simplest version is working age population times productivity. How many workers do you have and how productive are they? Well, productivity is kind of flattened out. If the workers are going to collapse by a third, that means your economy is going to collapse by a third or more. So they are in desperate straits. Now, the smartest people in the Chinese Communist Party know this.
That's great. Well, Jim, thank you so much for your time and your disposition on all these really, really important topics. I look forward to having you on the show again. Thanks so much once again.
Thanks.